All right, let's dive into the 2013 Homeownership and Equity Protection Act rule. You probably know it as HOEPA. Our goal today is simple, to take this really complex regulation and turn it into a clear, straightforward guide for compliance. So, if you're a compliance pro, a loan originator, or a creditor, think of this as your roadmap for navigating high-cost mortgages. We're going to decode this piece by piece.
So, here's how we're going to break it all down. First up, a quick refresher on where HOEPA came from. Then we'll figure out which loans you even need to worry about. After that, we'll get into the real heart of it, the three big tests that determine if a loan is high cost. From there, we'll look at all the rules that kick in, what terms are banned, what practices are prohibited, and finally, we'll wrap up with the must-do counseling and disclosure rules. Let's jump in.
Okay, first things first, a little bit of background. HOEPA isn't new, but it has definitely changed over the years. You know, a key shift was the name itself. We went from calling these things Section 32 loans, which is pretty vague, to the much clearer high-cost mortgages. And that wasn't just for show. It was a signal that the rules protections were getting a lot broader.
You can really see the evolution right here. HOEPA started way back in '94, but the real game changer was the Dodd-Frank Act in 2010. It didn't just make a few small tweaks, it blew the doors open, expanding HOEPA's reach to cover way more loan types. Then, the CFPB's 2013 rule put all those changes into action, creating the system we've been working with since early 2014.
Now, for what is maybe the most important first step for any compliance officer, figuring out which loans this rule actually applies to. You can't just guess here, you have to get it right. The rule is super specific, so let's break down exactly what's in and what's out.
Think of this as your first filter. Everything on the left, you've got to test. And notice, purchase money mortgages and HELOCs are on that list. That was a huge expansion thanks to Dodd-Frank. The one thing they all have in common? The loan has to be secured by the consumer's main home. Everything on the right, like reverse mortgages or loans for vacation homes, is completely exempt. This is your first, most critical checkpoint.
Okay, so you've run a loan through that first filter and confirmed it's subject to HOEPA. Now you're at the main event, the three coverage tests. This is where a regular mortgage can officially get stamped as high cost, and that triggers a whole new set of rules you have to follow.
Now here is the absolute most important thing to remember about these tests. A loan only needs to fail one of them. That's it. Trip the wire on the APR test, or the points and fees test, or the prepayment penalty test, and boom, it is officially a high-cost mortgage. That's why we have to understand each one perfectly. Let's start with the APR test.
The APR test is pretty straightforward. You're just comparing your loan's rate against a benchmark, the average prime offer rate, or APOR. The thresholds are right there, 6.5 percentage points over APOR for most first liens and 8.5 for junior liens. But, and this is a huge compliance trap, the APR you use for this test is not your standard TILA APR. For variable rate loans, you have to use whichever is higher, the introductory rate or the fully indexed rate. That little detail can easily push a loan over the line if you're not paying close attention.
All right, on to the second test. And honestly, this is the one that can get really tricky. The points and fees test isn't as simple as it sounds. The definition of points and fees is incredibly broad, and you have to account for a whole bunch of different costs. So what exactly goes into this calculation?
Yeah, this calculation is way more than just discount points. You start with most of the items in the finance charge, sure, but then you have to add in the loan originator's compensation. That's a big one. You also have to include some real estate fees if they aren't legit third-party charges. But here's the craziest part, the real tripwire. You have to include the maximum possible prepayment penalty in your calculation, even if the borrower never actually pays it. That's where a lot of these calculations go wrong.
So once you've added all that up, you compare your grand total to these thresholds. For most loans, those $20,000 or more, the trigger is 5% of the total loan amount. For smaller loans, it's a bit different, the lesser of 8% or $1,000. And you have to remember, these dollar amounts get adjusted for inflation every year, so it is absolutely critical that you're using the right numbers for the year the loan is originated.
The third and final test is, thankfully, a lot more straightforward. Basically, it sets a hard ceiling on prepayment penalties for any loan that's being tested under HOEPA. If your loan has a penalty that sticks around for more than 3 years, or if it costs more than 2% of the amount being prepaid, it's automatically a high-cost mortgage. It's a very clear, bright-line test that's pretty hard to mess up.
So what happens if a loan actually fails one of those tests? Well, it's not just a label. That high-cost mortgage designation immediately flips a switch, activating a whole set of really powerful restrictions.
And it starts with banning some of the riskiest loan features that have caused problems for consumers in the past.
This is the rule's protective shield kicking in. As soon as a loan is flagged as high cost, all of these features are just off the table. Prepayment penalties? Gone, completely banned. Balloon payments? Almost always banned, with just a few tiny exceptions. And other risky stuff, like negative amortization where your loan balance actually goes up, or jacking up the interest rate if someone defaults, also prohibited. It's all about stripping the most predatory terms out of these loans.
But the protections don't stop there. The rule goes even further. It also targets specific behaviors, fees, and practices that creditors might use, things that could trap a borrower in a bad situation. Let's take a look at what's forbidden.
This is all about basic fairness. You can't finance the points and fees, which is a practice that just inflates the loan from day one. Late fees get capped at 4% of whatever is past due. And if a borrower is struggling and needs help, you can't charge them a fee just to modify their high-cost loan. The rule also makes it illegal to tell a borrower to default on another loan just so you can refinance them. And of course, there's a catch-all rule against trying to cleverly structure a loan just to get around HOEPA.
And now, we're at the final pieces of the compliance puzzle. See, the rule doesn't just ban bad things. It also requires you to take proactive steps to make sure the consumer really, truly understands what they're getting into. And that's done through some very specific disclosures and mandatory counseling.
And this is not your typical stack of paperwork. A special written disclosure has to be given at least 3 business days before the closing. The whole point is to be crystal clear about the risks involved. It has to spell out in no uncertain terms the consequences of default. It lists the APR, the payment amounts, and for a variable rate loan, it even has to show the highest possible payment. The goal here is 0 surprises.
This is the final safeguard, and it is a non-negotiable step for compliance. Before you can close on any high-cost mortgage, you, the creditor, have to get a written certificate that proves the consumer went through counseling with a HUD-approved agency. And the timing is key. The counseling has to happen after they've seen the disclosures. Without that certificate in hand, you cannot close the loan. It's that simple.
When you boil it all down, complying with HOEPA is about so much more than just checking boxes on a form. It's a framework designed to make sure that when this type of high-cost credit is offered, it's done with total transparency and with real, powerful safeguards in place. It's about upholding the integrity of the whole lending process.
So, we've gone from the history of HOEPA to figuring out which loans are covered, to mastering those 3 crucial tests, and understanding all the protections that follow. We've laid out the entire map. So the last question is really for you and your organization. Now that you have this clear path, are your systems, your training, and your processes truly ready to handle the HOPA framework every single time? Because when it comes to compliance, that's the only standard that matters.